If a stock has 25 buy ratings and is basically printing cash, but its own insiders are selling millions of dollars worth of shares, I mean, is it an undervalued gem or are you just walking straight into a value trap?
Yeah, that is the million-dollar question right there.
Right. Because right now, AppLovin ticker APP is just completely tearing Wall Street into two distinct camps. As of today, April 17th, 2026, the stock is trading at around $473.25.
And we're seeing this bizarre disconnect, You've got massive institutional buying on one side and then executives rushing for the exits on the other.
Exactly. So for everyone joining us, our mission in this deep dive is to cut through the extreme noise around this wildly volatile stock.
Yeah, we're mapping out both the bull and the bear cases today.
We've pulled the latest market data, technical charts, income statements, and some fiercely debated analyst notes. And before we get into it, please like the video and subscribe to our YouTube channel. And it's compulsory to leave comments and feedback down below. Let us know what you think.
And just a quick reminder for you all, this deep dive is an impartial exploration of the facts. We're looking at the natural market debate here, but this is absolutely not financial advice.
No, definitely not. We're just here to examine the machinery under the hood. So looking at the financials, the pure fundamentals, it really forces you to ask why this stock is even struggling on the charts at all right now.
Right, because before we look at the immediate pressure, you have to acknowledge the raw financial horsepower that drove them to that staggering 52-week high.
Which is $745.61.
Exactly, up from a 52-week low of just $222.02.
That volatility is insane. It tells you the market is really struggling to price this asset.
It is, but that trajectory to the 745 high wasn't just, pure speculation. It was fueled by some undeniable aggressive cash generation.
Oh, for sure. I mean, the trailing 12-month revenue is $5.48 billion and a normalized net income of $3.43 billion.
Yeah, when a company pulls in those numbers, the market takes notice. The sheer acceleration at the end of fiscal year 2025 is what completely re-rated the stock.
Let's talk about that Q4 2025 data, because net income didn't just grow. It exploded.
Exploded is the right word. 115% year-over-year growth to hit $1.10 billion in a single quarter.
And the free cash flow jumped 88%. They reported $3.95 billion in free cash flow for the full year.
Which is huge, because that cash allowed them to do something pretty much unheard of in this current interest rate environment.
Yeah, slashing their net debt.
Right. From $1.8 billion down to roughly $1 billion.
In one quarter?
In 3 months. Paying off nearly $1 billion in leverage that drastically changes your risk profile. It permanently alters their cost of capital.
Right, because by deploying that cash to wipe out high-interest debt, every future dollar of operating income just flows so much cleaner to the bottom line.
It's like a snowball effect for profitability. But, that financial engineering brings us to a massive valuation puzzle.
The market cap right now is sitting at $157.2 billion.
And we're looking at a trailing PE of 46.42.
And a forward PE of 30.21. This is where I really struggle with the current valuation, to be honest.
How so?
Well, a trailing PE over 46, you're paying a massive premium for yesterday's news. Like, paying down debt is fantastic, but hasn't all that Q4 success already been totally baked into the price?
That's the big debate. Even with a forward PE of 30, you're pricing in an assumption of basically flawless execution.
Right. If they stumble even a little bit, that multiple is going to compress violently.
The growth premium is the whole issue here. A multiple of 46 implies the market demands sustained high double-digit growth. If investors start to sniff out that the 115% growth from Q4 was, a peak rather than a new baseline.
Those multiples become incredibly dangerous.
Exactly. Which brings us to the actual price action we're seeing today.
Yeah, because if the fundamentals are this financial juggernaut, the short-term trend is flashing some severe warning signs.
Very severe. The immediate momentum is completely decoupled from that long-term income statement.
So today the stock's at $473.25. It's getting a little 1.86% bump today, trying to recover. But the technical reality over the short term is neutral to decidedly bearish.
We're watching a stock trapped in a brutal consolidation phase. It's really trying to digest that massive haircut from the $745 high.
The battle lines are drawn pretty clearly on the chart.
Very clearly. The support floors are sitting at $413.25, and below that, there's a critical line in the sand at $392.10.
While the immediate ceiling, the resistance, is knocking right at $473.50.
Great, and if buyers can force it through that resistance with some actual volume, the model suggests $520 is the next logical target.
But the internal indicators are showing this bizarre tug of war. Like, look at the 14-day RSI. It's at 66.98.
Approaching overbought territory.
Right, which usually flashes a buy or neutral signal.
Yeah.
But you pair that with a deeply bearish MACD sitting at negative 18.1 cents.
And the moving averages tell a very dark story, too.
Yeah, it's trading 0.4% below the 20-day simple moving average.
Which just shows short-term weakness. But trading 21.7% below the 100-day simple moving average, that's a massive bearish divergence.
Let's unpack that contradiction for a second, because a rising RSI with a negative MACD often traps retail traders, doesn't it?
Oh, all the time. The RSI is telling you there's short-term buying pressure. People are trying to catch a falling knife.
But the MCD and that huge gap with the 100-day moving average reveal that the intermediate momentum is still completely controlled by algorithmic sellers.
Exactly. The longer-term trend channel might be rising, but right now, the stock is essentially swimming against a riptide.
It's like the long-term current is pulling it out to sea, but the immediate waves are just smashing it back against the shore.
That's a perfect analogy, and if the technical models are this conflicted, it perfectly explains the civil war happening behind the scenes.
Between Wall Street analysts and AppLovin insiders, the divergence in sentiment here is genuinely shocking.
Let's start with Wall Street. The analyst consensus is overwhelmingly, almost aggressively bullish.
It's crazy. We have 25 strong buy ratings, 4 holds, and 0 sells.
Not a single institution in our source material is advising their clients to sell.
Right. The average price targets are hovering between $646.86 and $680. And Bank of America has planted a flag all the way up at $860.
Which implies nearly a doubling of the current stock price.
Bank of America's target relies on a framework that views AppLovin not just as a mobile ad network, but as this indispensable AI software layer.
Right. The bulls on Seeking Alpha point heavily to the adjusted PEG ratio, the price to earnings to growth ratio.
They have it calculated at just 0.6x.
And in growth investing, anything under a 1.0 suggests the stock is severely undervalued relative to its expected earnings growth.
They're arguing that paying 25 times forward free cash flow is an absolute steal for a company generating this much cash.
But relying on an adjusted PEG ratio of 0.6x is incredibly dangerous if the growth half of that equation falters.
Which is exactly why the bear camp is ringing the alarm. You look at Guru Focus, they're pointing at the macro environment and historical multiples, and they classify AppLovin as a severe value trap.
Yeah, their models calculate the stock as 59.2% overvalued compared to its GF value of just $269.17.
Wow, $269. That's a huge drop from where we are today.
They're looking at a stock that has just run too far, too fast, and is now priced for a reality that might not ever materialize.
Which introduces the single biggest red flag in all of our sources today. The insiders.
The people who actually possess asymmetric information about the company's daily operations.
Exactly. And they are liquidating their positions. Insiders have unloaded roughly $169.6 million worth of shares in just the last 90 days.
It's staggering.
We're seeing major moves, like Director Eduardo Vivas, selling 20,910 shares to net roughly $9.6 million.
Yeah, and you have to think about the mechanics of this.
Right. Help me understand this. Because you have institutional buyers flooding in, largely because AppLovin was added to the S&P 500 and the NASDAQ 100.
Which forces passive index funds to buy the stock regardless of the price.
But at the same exact time, the executives are rushing for the exits. What is the signal there?
Well, the signal requires looking at market liquidity. When a stock gets added to the S&P 500, it creates this artificial, massive wave of demand from index funds.
And the executives know this.
Of course they do. They know that this inclusion provides a liquidity backstop. It's a floor of buyers. Now, insider selling is often dismissed as, routine portfolio diversification.
Sure, executives get paid in stock, they sell to buy a house or pay taxes.
Exactly. But liquidating nearly $170 million in a 90-day window, that is not routine diversification.
No, that's cashing out.
Right. Bears interpret it as management recognizing a local top. If the people building the engine truly believed the stock was heading straight for Bank of America's $860 target, they'd hold those shares.
Yeah, why sell now if it's going to double?
Exactly. By selling into the forced liquidity of the S&P 500 inclusion, they're utilizing those passive buyers as an exit strategy.
So the index funds are essentially providing the liquidity for insiders to cash out at premium multiples.
That's the bear argument, yes.
This is a terrifying dynamic for a retail investor buying at these levels. Ultimately, though, whether a Bank of America's $860 target or Guru Focus's $269 target is correct, it really depends on the operational execution going into the rest of 2026.
Yeah, the financials we just discussed are merely the scoreboard of past performance.
Right, the future valuation relies entirely on the actual business drivers going forward, specifically their Axon AI engine.
The bull case basically hinges entirely on Axon.
The sources highlight that this AI technology is doing something pretty unprecedented for ad efficiency and profit margins.
Instead of the traditional shotgun approach to mobile advertising, just spraying ads everywhere and hoping for a click, Axon operates like a heat-seeking missile.
It predicts exactly which user is going to convert.
Right. And that allows AppLovin to charge advertisers a massive premium because the return on ad spend is practically guaranteed.
And that predictive efficiency is the mechanism driving their massive margin expansion.
Exactly. If an advertiser knows Axon will deliver a paying customer, they'll bid significantly higher for that ad placement. AppLovin captures that spread.
Plus, the bulls are pricing in the launch of their new self-service tools targeting the e-commerce sector.
Right, expanding outside of their traditional mobile gaming stronghold is viewed as the primary catalyst right now.
They're projecting this will pave the path to an astonishing $5.8 billion in free cash flow for 2026.
Which is wild. Generating $5.8 billion in cash gives them absolute freedom to wipe out the rest of their debt.
And initiate massive stock buybacks.
Which would theoretically artificially inflate the EPS even further.
But this is where the bear case really exposes the vulnerabilities. We mentioned earlier the danger of pricing a stock for perfection.
Yeah, multiple compression is a real threat.
But beyond that, the bears are heavily scrutinizing the opacity of these new metrics. Management is aggressively touting this e-commerce expansion as the next big frontier.
Oh yeah, they're hyping it up.
But they are flat out refusing to break out the exact e-commerce numbers in their filings.
And opacity in financial reporting almost always breeds market anxiety.
When a company claims a new segment is revolutionary, but refuses to provide the granular data to actually verify the adoption rate, you have to question the motive.
You really do. Let's theorize on this.
Okay.
Are they keeping those numbers opaque because they're a nascent, highly strategic revenue stream, and they just don't want to show their hand to competitors?
Or are the margins actually degrading, and they're hiding slow e-commerce adoption behind the massive cash flow of their legacy gaming network?
The market tends to assume the worst in the absence of data.
Naturally.
Bears argue that if the e-commerce self-service tools were truly experiencing explosive, profitable adoption, management would be breaking those numbers out on the front page of their earnings report.
Right, to justify that 46 trailing PE.
Exactly. By burying the numbers, they leave the stock super vulnerable to broader macroeconomic shocks.
And those macro risks are very significant right now. The sources highlight warnings of potential SaaS sector correction. Analysts are actually calling it SaaSmageddon.
Catchy, but very serious.
If the broader software as a service market contracts because high interest rates are strangling B2B budgets, AppLovin will get dragged down with the sector.
Regardless of how efficient the Axon engine is.
Exactly.
We also have to consider the long-term threat of AI disruption in game development itself.
This is a huge point. Ativan's current cash cow is the mobile gaming ecosystem.
Right. But if generative AI dramatically lowers the barrier to entry for creating mobile games, the market could just be flooded with infinite AI-generated content.
So how does an ad network maintain premium pricing in a completely saturated, hyper-fragmented ecosystem?
It completely flips their leverage.
It does. So let's try to synthesize the outlook here and separate the short-term noise from the long-term thesis for our listeners.
Well, short term, all the sources agree we are facing extreme volatility.
That $473.50 resistance level is the immediate battleground.
Right, and if it fails to break through there and the algorithmic selling really takes over, it will likely drop to test that $420 support floor.
Conversely, the long-term outlook remains almost entirely tethered to the AI growth rate.
If they can maintain an AI-driven growth pace of 45% or higher, the technical models project summer 2026 targets approaching that $750 mark.
Essentially recovering the previous highs.
Exactly.
The ultimate crucible for all of this is coming up on May 6, 2026. With their Q1 earnings call.
That is the big catalyst to watch.
The market is going to demand transparency on those e-commerce numbers, and they'll need to prove the Axon engine is still running hot enough to justify the multiple. That earnings report is going to force a reconciliation. It will dictate whether the forced liquidity of the S&P 500 inclusion is just masking the insider exits, or if the fundamentals can overpower the technical weakness.
All right, let's pull this all together for you. AppLovin is undeniably a cash flow printing machine. They wiped out nearly $1 billion in debt in a single quarter. They generated $3.43 billion in net income, and they possess a highly efficient AI targeting engine.
Yet at the same time, they are fighting severe short-term bearish momentum, massive internal sell-offs from the people who know the company best, and navigating sky-high valuation expectations.
Expectations that demand pretty much flawless execution in a really tough macro environment. The tension between their fundamental strength and the market mechanics here is profound. But as we wrap up, I want to leave you with a much deeper puzzle to mull over.
Let's hear it.
So AppLovin's entire valuation relies on Axon making ads hyper-efficient, right? It's
Right.
their golden goose.
Right. It's literally the only reason advertisers pay the premium.
But AI is not a static technology. We are rapidly moving toward a world of autonomous AI agents.
Okay, where are you going with this?
Think about a near future where you simply tell your personal AI to find and purchase the best running shoes for you. Or, download the most engaging strategy game.
Oh, wow.
The AI agent searches the web, analyzes the data, and executes the transaction entirely autonomously.
Completely bypassing the traditional user interface. And the ads.
Exactly. If AI agents organically connect products directly to consumers without human browsing, where does that leave an ad network?
The entire concept of an impression or a click-through rate just becomes obsolete.
Could the very technology driving AppLovin's explosive growth today eventually allow developers and brands to bypass ad networks entirely?
That is wild to think about. Will AI prove to be their greatest catalyst or the ultimate disruptor that just renders their whole business model irrelevant?
Are they perfecting the engine for a car that won't even need to be driven in 5 years?
That is an incredible thought to walk away with. We really want to know where you stand on this. Are the insiders cashing out before the disruption? Or are the algorithms trapping retail traders out of a massive growth story?
Make sure to leave your thoughts on the platform.
Yeah, let us know in the comments. And remember, this deep dive is strictly for educational exploration to help you understand the mechanics at play. Keep analyzing the data, keep questioning the consensus, and we'll catch you on the next deep dive.